All right, everyone, welcome to today's live stream. It's Monday, September 16th, 2024. Hope you're doing well. All right, let's talk a little bit today about the condition of the markets and what the Fed might do in their on their meeting Wednesday, this coming Wednesday, the 18th. This is the next FOMC market meeting. It is widely suggested that the Fed will cut rates on this meeting on Wednesday. I think that's going to be the case, and I think it's going to be important to evaluate your portfolio based on current market conditions, the potential for history to repeat itself with Fed rate cuts. Historically, when the Fed has reversed their position and gone from a constricted, elevating interest rates to a loosening of the Fed policy, reducing rates, actually the markets have dropped historically. So if history does repeat itself, we might be in for a bit of a drop. And, it actually would make sense that there would be some type of leveling out between market valuations for companies and a connection with the economy that's so many people are having a difficult time. I mean, I continuously come across videos and posts and things of people really struggling, and it's difficult, it's challenging. We know that there's a tremendous number of businesses closing and layoffs as well. Here's the list from dailyjobcuts.com. I mean, you can just see these are the closing. I think I mentioned this last week that the closing category is bigger now than the layoff category, where that used to be reversed. The layoffs were much more robust and closings were less, but now we're just starting to see closing after closing across the board. More bankruptcy filings, still layoffs for sure. Some big ones here. I mean, you can see Boeing considers layoffs to cut costs during strike, and all these are clickable links, so you can go to the full article if you're interested. But Microsoft, 650 people from their video game workforce. Price Waterhouse Coopers US unit, 1,800 people. Verizon to eliminate 4,800 by next spring. I mean, when you start to see layoffs to this extent, you just wonder, what is happening? Obviously, companies want their stock to perform. When a company has less expenses, employees are expensive for a company, it makes their numbers look better. I mean, let's face it, that's the reality. And but wow, it's just mind-boggling how many people continue to lose their jobs. And we've seen this year over year over year at a time when there's stagflation, prices continue to remain high. That doesn't seem like that's changing anytime soon. It almost to some extent feels like the Fed wants to just sink the US economy. There, I said it. It just feels like, these reduction in interest rates have come, in my opinion, way too late. They should have been changing course 2 years ago when companies were really ramping up the layoffs. Now it kind of feels like these companies laying off people and closing, like these are the ones later to the game. But when you talk about a telecommunication, this is the one that really, I think, is the most disturbing, is this Verizon one, 4,800 by next spring. I don't know how many employees total Verizon has, but that sounds like a lot of employees. And since they're already planning this staggered layoff until next spring, you just have to wonder, why is that? Why are so many companies either going bankrupt, closing their doors, laying off more and more workers? It just makes you wonder. And with this type of approach, with two things going on, the U.S. economy dare I say, the global economies are really having a difficult time. Companies, more and more companies laying off workers, people barely making ends meet at this point. There's just, and I'm not telling you anything you don't know already. I just want to bring to the light, at some point there has to be some type of match from the stock market into like normal day-to-day economy, and therefore some type of valuation in line more with the economy. So we don't know, the market's expecting 100 basis point cut this year in 2024, the remainder of 2024. And we don't know, exactly what that's going to look like this week, although there's a lot contingent upon this rate cut. But what we do know is this means that as an investor, as we navigate this time, we need to be much more aware of companies and the debt they have on their balance sheet. Now, rate cut will help if the companies can refinance their debt, but if the Fed goes about it a quarter percentage point or 30 basis points, or mostly it's quarter increments, it's going to be too little too late. And what will happen is that companies won't be able to refinance their debt for another probably 18 months down the road. They'll still have very high debt expenses. That does affect their balance sheet and how they can navigate through this environment, as well as the consumer pulls back. When we start to see Dollar General stores posting weaker earnings, dollar stores closing down, you start to go, well, what the heck is going on? So, but when you start to understand that, this is something that is not going to stop, that prices are going to continue to stay elevated and or go up where they can raise prices. Now we're seeing huge increases in insurance policies, right? For homeowners, car insurance, especially if you're in an area that gets flooded or wildfires. Companies are just flat out either not honoring or not paying out the benefit to the insurance policyholder. So someone may hold insurance for 20, 30 years, and then when they finally need to submit a claim, they may not be getting that money, or it's dramatically reduced. So there's some things to really consider and look at in terms of what's going on. But it's a perfect excuse to raise premiums if you're an insurance holder, and at some point we all are, depending on if you own a car, a home, what have you. So we're going to see insurances go up. Property taxes are going to continue to go up because prices aren't coming down, especially in Canada anytime soon. They continue to go up and up and up. And it's just mind-boggling how real estate can go up 20, 30, 40% in a year. It makes zero sense. But to navigate this time, we need to go to looking at companies to invest in that have low debt. That is crucial in this environment, is companies that have little to no debt. And they're not easy to find, but I do have, by the way, we've got the NASDAQ down 105 points, the Dow up 181 points. Crude is holding its own, actually up 2.5%, 70.38. Silver up 30 to 31.17. Gold at 2,600. The NASDAQ, as I mentioned, the NASDAQ is down. Bitcoin, a little off today, but it's had a huge move last week. And, so not a lot going on. There's gold at 2609. Not a lot going on, but nevertheless, it always seems like something is happening that's important. So nice move on our To the Moon stock rocket section, MFA Financial, 1316 today. We started talking about this early September. It was $12.50 a share. And this is the 8th day that it's made this list. So that's a company to look for. But you might have seen this article, or maybe not, but it's an article about, forget Walmart, the biggest retail stock split of the year has arrived. and that's Deckers. Deckers, symbol is DECK. They have a 6-for-1 split. Let's see. After the close of today, 6-for-1. So instead of 900 and some odd dollars a share, it's going to open up tomorrow morning at 156. Very, very interesting. I've often thought this company was overvalued in terms of its market price, but the more I delve into their balance sheet and notice they have very little debt, that is what is going to continue to help them drive their acquisition strategy. They're the brand that owns UGG, Hoka. These are some of their brand deals they did recently. UGG, Hoka, Teva, Hoka, 420 million in the last quarter. UGG, 195 million. Teva, 48 million. And that's what accounts for, that's the sales under their umbrella of companies. So yeah, very interesting. They don't have to tie up its cash, and inventory manufacturing has led to superior margins for the company. But here's the cool thing. But the most exciting aspect of their strategy has been its international expansion. E-commerce is just getting off the ground in international markets, which affords the company a sustained double-digit high-margin growth opportunity. This is their cash value, $1.438 billion. We rounded up to $1.44 billion. They say it's debt-free. It's still, as we did our analysis, we came up that actually they have a few $100 million in debt. But based on the cash on hand, it would be very easy for them to clear up that debt. It has a financial flexibility to make deals happen, just as it did when it purchased UGG back in '95 and Hoka back in 2012. While this sizable stock split is long overdue, it's also been argued that Deckers Brands has some work to do to grow its current valuation. Although the company's stock is absolutely deserving of a premium given the momentum it's enjoyed from the DTC growth, its international push, and its top-tier branding, shares are trading at 26 times forward earnings. This might not seem like a steep price to pay, but consensus annualized earnings growth over the next 5 years is a modest 11.4. In this type of market, to have a 26 forward price to earnings ratio, I don't think is a big deal. I mean, there are many companies that trade in the hundreds, and they're not even tech companies. So to have a retail brand trade, consumer brand, I would put this under probably consumer durable, but to have this brand trade at 26 times forward earnings, I don't think is a big deal. But we'll see. That it remains to be seen. I want to share with you. So here's the company, Deckers Outdoor Corp. This is their current stock chart for the year. It's about doubled in price. A year ago it was $526 a share. Today it's at, as you can see, $936 and change there. But this is the financial health of a company. So as we evaluate this decrease in interest rates, and really part of what the Fed is going to have to come to the table with is recognizing that we are borderline recession or in a recession. That's why these interest rates are going to start coming down. And in that type of environment, we got to only look at companies with very strong financial health. So I don't know if you've noticed, but we've added this metric, this financial health scoring, to our software, and it calculates a score and it adds into the North Star final ranking. So this stock is a four-star ranking, and this contributes to it. So their intrinsic value, not a huge difference from where the stock is currently trading to its intrinsic value, but nevertheless, it's still trading below its intrinsic value. So that's a good sign. Probably the most glaring is their debt to equity ratio. Their total debt, as I mentioned, is $262 million, as opposed to total equity, which is in the billions. And so 262 million to 2 billion, vastly different, a lot of equity there. And then we've got the operating cash flow compared to capital expenditures ratio. Operating cash flow far exceeds capital expenses. So that's a very positive thing. That's why it has 5 stars. And levered free cash flow to total debt ratio. Levered free cash flow means they're making money every month, month after month, and as opposed to their total debt. So again, much more cash as opposed to their debt. So it's looking good in terms of cash flow. What this means is there's enough cash flow to cover any interest expense or any business expense related to running the company and or to its debt. So what we would do to find that out for all companies, because again, you want to make sure that you're doing this search for all companies, is our page pops up on valuations, but you'll want to click financials. And you're looking for a few things here. You're looking for a positive profit margin. This one's up 18%. We're looking for the total cash that this company has. Most recent quarter is 1.44 billion on hand, as opposed to total debt. Most recent quarter is only 262 million, which we just saw in the numbers above. So you just want to make sure a company has a lot of free cash flow, has a lot of cash as well, and that they're growing book value. Let's see, per share, $81.59. The stock is trading at 935. I wouldn't be too concerned about that. More so just looking at how much cash and levered free cash flow they have. Operating cash flow is that, what's available to use, a little over $1 billion. Levered free cash flow is that trailing 12-month, 779 million. So their business is profitable. They are making money. They're operating at positive EBITDA, which is very, very important in this market, to the extent if we continue to, as the Fed leads into rate cuts and we navigate this recession that we're most likely in the middle of. Hope this was helpful. Thanks so much for your support, and we'll see you next Monday. Have a great week, everyone.